Welcome to this Trading Room Live. My name is David Hickson, and I am delighted to welcome you all to our second live Hurst Trading Room. In today's webinar, we're going to be speaking about crude oil, and we are also going to be speaking about the principle of synchronicity, one of my favorite principles in the Hurst Cycles list of principles. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. They are very important and they are, of course, legally obliged. Just a few points about the chat window and the way in which this webinar works. It can be very difficult for me to keep an eye on the chat window while I'm speaking, and I want to try to get across as much information and make this as useful as I possibly can. And so I'm not going to be watching the chat window. Please don't be offended if I don't respond to your chat messages. But our Chief of Support, Sam, is here with us again today, and he will be passing on any questions to me. And I will break occasionally to answer questions. And of course, the last 20-minute webinar or so, we will dedicate entirely to answering your questions. So let's get started. In today's webinar, I'm going to be speaking about the principle of synchronicity. Now, Hurst defined 8 principles, of course, which are Hurst's cyclic theory. When he published his Hurst Cycles course, he defined or declared 8 principles, and those principles taken together define his cyclic theory. They're a little like the axioms that define a mathematical theory. The principle of synchronicity is principle number 5. It is one of the most important principles of Hurst cyclic theory, and it is the principle that raises the most questions. And when we were putting together the subjects for these webinars, we were looking at what would be the most valuable topics to start with. And the principle of synchronicity was the one that certainly raises the most questions. What is the principle of synchronicity? Well, there it is, written there as it is in Hurst Cycles course. The principle goes like this. It states that waves in price movement are phased so as to cause simultaneous troughs wherever possible. So let's break that down and just make sure that we really understand it. Waves in price movement. We know that, of course, Hurst cyclic theory describes price movement as being influenced by a very large number of cycles, an infinite number of cycles, and of course each cycle could be considered to be a wave. And so this principle is stating that waves in price movement are phased. Now, what does phased mean? Well, when you speak about the phasing of a cycle, you're really saying how far is this cycle along in its journey from trough to peak and back to trough again. So the waves in price movement are phased. In other words, the cycles are aligned, or they are traveling along their journey from trough to peak, back to trough again. They are aligned so as to cause simultaneous troughs wherever possible. So that's the really important point right there, simultaneous troughs. What that means is that the cycles, and we have many cycles that we speak about all the time, the 40-day cycle, the 80-day cycle, the 20-week cycle, so on and so forth, those cycles are arranged in the price movement such that they have simultaneous troughs. The troughs occur at the same time. Now, they don't always occur at the same time. They occur at the same time wherever possible. Does it mean that the markets say, okay, well, when I can, I will make those troughs happen at the same time? No. What it means is that whenever it is possible that 2 cycles have troughs occur at the same time, that will happen. Why is it not always possible for this to occur at the same time? Well, consider an 80-day cycle. It has a trough every 80 days. The 40-day cycle, which is the next shorter cycle, has a trough every 40 days. So if you have a trough of the 80-day cycle occurring simultaneously with the trough of the 40-day cycle, then the next trough of the 40-day cycle will be occurring around about the peak 80-day cycle. So it's impossible for those troughs to be synchronized or to occur simultaneously. So that's what it means, that troughs will happen simultaneously wherever possible. And when we take a look at some drawings, and I've got lots of drawings to show you today, that will become a lot clearer. Now, a really important principle, And one of the first questions that it always raises is why troughs? That's fine that cycles are arranged in a particular way in the market, but why are these troughs synchronized? And how do we know that the troughs are synchronized? It's all very well for Hurst to have said, oh, yes, the troughs are synchronized, but why? How did he know that, and why are those troughs synchronized? I cannot tell you why Hurst declared are synchronized, but I can demonstrate to you how the fact that troughs are synchronized is exhibited in price movements of stock markets. Now, it's a very important point. Hurst, when he published his cycles course in 1972, had spent many years analyzing the price movements of US American stocks. That's what he did. He got a lot of price data for American stocks, and he analyzed that. It's a really, really important point. He also analyzed gold and various other things, but by far the bulk of his analysis was performed in American stocks. And so I'm going to show you how the fact that troughs are synchronized or occur simultaneously turns out to be true for stocks. It might not be true for all instruments, and that's something we're going to come back to. But let's try to answer this question: why are troughs synchronized? Now, we find evidence of the fact that troughs are synchronized in the shapes of the cycles. So if we take a look at the shapes of the cycles that we find in markets, then you will see shapes actually corroborate this principle. They show us that, yes, the troughs are synchronized. And that's because we get M shapes and W shapes in the markets. I'm going to demonstrate that to you today. I speak about M shapes and W shapes all the time in the market, so you're probably very familiar with it. I won't dwell on it too much. The important thing is that an M is pretty much an upside down W, or if you like, a W is pretty much an upside down M. As you can see from the font that I've used to write this, the M looks like an upside down W and vice versa. So let's see how the shapes of cycles and the M's and W's that we find in price action actually demonstrate this principle of synchronicity. So here I have a whole lot of pictures to show you, and now what we're going to be looking at here is we're going to be looking at idealized shapes that cycles would make in the market. So we're going to start with this picture over here, which shows us a typical sine wave, and you all know that a sine wave is used to represent a cycle. Sometimes it is, of course, pushing the market up. Let's see if I can get this pen going. Here we go. So sometimes it's pushing the market up over there, and at other times, of course, the cycle is pushing the market down like that. Okay. What we see here is we see two waves or two examples of this particular cycle, which we could simply call the blue colored cycle. And as you probably also know, we measure the wavelength of the cycle from one trough, such as over here, to the next trough over there. That's the wavelength of the cycle. We could also measure the wavelength of the trough from the peak to the next peak. It's the same measurement, of course, in the case of a sine wave. And so that is a graphic representation of a simple cycle. Now, what happens when we combine more than one cycle? Because we know that Hurst cyclic theory tells us that multiple cycles combine. Well, here's a picture of two cycles that we haven't combined them yet. There are two cycles which could be influencing price movement. The important thing to notice about these two cycles is that the red cycle has a wavelength which is equal to double the wavelength of the blue cycle. I'm sure you can see that. The distance between the two troughs of the red cycle is double the distance between the two troughs of the blue cycle. You can also see why not all troughs can possibly be synchronized. And the reason for that is because over here we have, at the far left-hand side of the screen, we have a trough of the blue and the red cycle. In the middle of the screen, we have a trough of the blue cycle, but there is no trough of the red cycle because the red cycle is currently experiencing a peak at that time. So it cannot possibly be synchronized with the trough at that point. The next time at which the troughs can be synchronized is here at the right-hand edge of our chart, where the troughs are synchronized again. So these cycles have been arranged according to the principle of synchronicity. They have synchronized troughs where possible. In other words, or I should say simultaneous troughs where possible. The troughs are occurring at the same time where possible. Now, what happens when we combine these two cycles? We use another of Hurst's principles, the principle of summation, which is a very simple principle that I will explain to you at some later time, but that principle explains how we combine the cycles, and what we do is we simply add the cycles up. So we put the cycles together and we add up the influence that they're making, that they're having on the market, and the result is this green line over here. So that green line is the result of combining these two cycles. Now, can you see how that green line is describing a shape which is the M shape that I constantly speak about occurring in the markets because of cycles? It's a QM. This pen, I have dual monitors. This pen is really pretty complicated. Let me try again. So here is the M shape. That is the result of combining those two cycles. Now, I know none of this is news for any of you, but that is the result of combining those two cycles. Let's keep stepping it up. It's getting a little more complicated. Here we have cycles. Again, each cycle has a wavelength which is twice the length of the shorter cycle. The shorter cycle here is the orange cycle, then we have the blue cycle, then we have the red cycle. And in case any of you are wondering, the principle of proportionality has not been correctly applied to these cycles. I'm not going to dwell on that. Let's not get complicated. But here we have three cycles. The longer cycles do have slightly greater amplitude, and their wavelengths are each double the length of the shorter cycle wavelength. Let me show you the result of combining those cycles. And again, the green line that you see there is the result of combining cycles. Let me turn the pen on and clear that and show you how, again, we're getting an M shape. In fact, we are getting an even more exaggerated M shape. Now, what is causing that M shape? Well, yes, combining the cycles is causing the M shape. But the M shape itself is a direct result of the fact that the troughs of these cycles are synchronized, and that is, of course, the principle of synchronicity. Let's go a little bit. Let's combine 6 cycles. These 6 cycles are also obeying the principle of synchronicity. They have synchronized troughs, so these troughs, and that green line shows you the result of combining those cycles. Now, let's start speaking about what that green line is exhibiting. I mentioned that in order to answer the question why troughs are synchronized or happen simultaneously, we could look at cycle shapes. So let me speak about the result of combining these cycles with simultaneous troughs. The result is this. Look at our troughs. Our troughs are what I call sharp, isolated troughs. They are sharp, okay, very pronounced. We have a big plunge down into them, a big bounce out of them. That's a sharp trough, and they are isolated. They tend to occur on their own. By contrast, the peaks tend to be round and clustered. Can you see that? Peak is rounded and clustered. Okay, so that is the result of combining cycles that have their troughs occurring simultaneously, or they are synchronized. The result of this is that in bind movement, or our composite price movement, if you like, we get sharp isolated troughs and rounded clustered peaks. Okay, let's quickly take a look at what happens. Let me move that. Lots of cycles. Here we have the combination of, I think this is 11 cycles. And here you can see the cycles again at the foot of the chart. But can you see the really important point that I'm trying to make, which is that the result of the principle of synchronicity using simultaneous troughs is that you get sharp isolated troughs and you get generally rounded clustered peaks. Sharp isolated troughs, rounded clustered peaks. At this point, let me just take a look and see if there are any questions, and see if I can answer any questions about what I've said so far. I see Cedric has said, I guess one of my biggest question marks with Hurst analysis is finding out which cycles are more active than others at a given time. Okay, that's a really interesting question. It has to do with the amplitude of the cycle, of course, and there are various ways of doing that. Cedric, I'm not sure I'm going to get to answer that question in today's webinar. We can maybe have a look at it a little bit later, but make a note of it and try and get back to that question at a later webinar. I see a question from Erin. Do cycles, can they end quicker because of major news, etc.? Okay, again, a really interesting question. Does the speed with which cycles move change depending upon news items? And I'm not sure I'm going to get to answer that in today's webinar. According to her cyclic theory, cycles don't speed up necessarily because of news items. That's the simple answer. But because of the way cycles combine and because of the principle of synchronicity that we're speaking about today, they do appear to speed up. And perhaps that's the really important point. Let's get back to our discussion. Here is the idealized, if you like, price movement as a result of combining cycles that have simultaneous troughs. I haven't yet answered the question, why is it simultaneous troughs? Why is it not simultaneous peaks? What's actually going on here? So let's take a look and see what would happen if we combined those same cycles, but instead of aligning their troughs with each other, we instead aligned their peaks with each other. So we're going to start again with one simple cycle. It's the same cycle as I showed you earlier. It's the blue cycle, and here are two waves of the blue cycle, and it has the same wavelength and everything, but the difference is that I've aligned it slightly differently. You can see the peaks, of course, and you can see the troughs. Now let's add a second cycle, and here is our second cycle. It is the red cycle, so now we have the blue cycle and the red cycle. And I think you can see here that the peaks are occurring simultaneously over here and over here, but the troughs are definitely not occurring simultaneously. So this is an example of the principle of synchronicity inverted. So instead of us having simultaneous troughs, we have simultaneous peaks. Let's see what happens when we combine the price action, or when we combine these two cycles. Again, the green line is the result of combining these two cycles. And can you see how when we combine cycles that have simultaneous peaks as opposed to troughs, we get a W shape in the resultant price action, or the combination of those two cycles. We get a W shape as opposed to an M shape. Now let's combine three cycles. Here are the same three cycles. And again, I've aligned them in such a way, or I've adjusted their phasing in such a way so that the peaks are synchronized, but the troughs are not. Let's combine them, and there, that green line is the result of combining those three cycles. Do you see the very clear W shape instead of the M shape? Now, let's have a look at the result of combining 6 cycles, and I can begin to get a point here. Can you see the result of combining cycles that have simultaneous peaks is that you get sharp isolated peaks. On the other hand, you tend to get round clustered troughs. Can you see that? In other words, the troughs, although you do normally find a trough that stands out from the others, the troughs tend to be very close to each other. And they form a rounded shape because they are clustered together. However, the peaks are sharp and isolated. So the big difference between having synchronized troughs, synchronized peaks, is that you get different trough and peak formations in your market. Now let's have a look at comparing the or synchronizing the peaks of 11 cycles, and that is the price action that you get. And I don't think I even really need to make the point, but you can see very clearly sharp isolated peaks and generally rounded cluster troughs. Okay, so let's get back to answering the question, why troughs? Why did Hurst in his Principle of Synchronicity state that cycles were phased in such a way, or the waves of price movement were phased in such a way that they had simultaneous troughs? In my opinion, it is because he studied stocks. He studied the stock market, and the price action of stock markets tends to exhibit the characteristics of having simultaneous or synchronized troughs as opposed to synchronized peaks. Let's take a look at the stock market. And here is the S&P 500, the ES contract that we were looking at last week. I'm just going to show you the really sort of big picture. I'm going to ask you, can you see sharp isolated troughs or sharp isolated peaks? Some of you are going to say you see both. Yes, indeed, some of those peaks are sharp and isolated, but generally the troughs are sharp, isolated. There. Look at this one over here, that one over there, although that whole trough. Look at that trough over there. That's a really sharp, isolated trough, and the trough that we've seen recently in August is turning out so far to be a very sharp, isolated trough. So generally, in this price movement, which is of course the price movement of a stock index, so it's a stock market, in this price movement we get generally sharp and isolated troughs, and we get rounded peaks. Here you can see a rounded clustered peak, and here you can see another rounded clustered peak. Let me just zoom in and demonstrate that, because it's a really important point. If we zoom in and take a look at the last, what's that, about 2 years worth of price action, look at that really sharp trough over there and this really sharp trough over here. Typical examples of sharp isolated troughs. On the other hand, the peaks, can you see, have been rounded. Now, in November of last year, I wrote a blog post stating that I was expecting the peak of the 9-year cycle to occur in March of this year. But whenever I speak about an upcoming peak, I'm very careful to say, but remember, peaks are complicated. Markets, peaks are complicated. The markets will tend to go up and form a peak, then bounce up again, form another peak, then another peak, then another peak, and then yet another, and so on. Peaks are very complicated, and that is because of the principle of synchronicity. And I see David has mentioned the psychological reasoning, which is a really interesting point, and I'm going to get to that in a moment, and just discuss the psychological reasoning. So that's the answer to why troughs. I cannot tell you how Hurst discovered this, but I can tell you that the way in which price action behaves in stock markets exhibits the characteristics of the waves of price movement having simultaneous troughs. So that is why we do speak about the principle of synchronicity having simultaneous troughs in stock markets. However, let me show you another market, and this is in fact the price of coffee. Coffee is of course a commodity. It's not a stock. And let me show you this price movement and ask you the same question. Do you see sharp isolated troughs or sharp isolated peaks? Okay, I don't even really need to wait for the answer. It's fairly obvious. You see sharp isolated peaks and you see rounded clustered troughs. It happens again and again in the case of commodities. Now, I suggest that Hurst, when he defined the principle of synchronicity, had been working with stock markets, of course, which is why he defined the principle of synchronicity as having simultaneous troughs. I propose that when we analyze a commodity or a precious metal, that we need to consider that the principle of synchronicity is inverted in the case of the commodities, and that in fact cycles should be phased with synchronized peaks as opposed to synchronized or simultaneous troughs. Let's just extend this discussion slightly further and go back to our idealized price movements. And let's ask the question, what if the principle of synchronicity didn't actually exist? What if it was a myth? What if it was just a figment of our imagination? What if we combined 3 cycles and neither the peaks nor the troughs were synchronized? Well, then we would get that kind of price movement. That green line there, again, is the combination of those 3 cycles. We would get that kind of price movement. What can we say about that kind of price movement? Well, let's combine a few more cycles. Here we've combined 6 cycles. What can we say about that price movement? Well, I've been speaking about rounded, clustered peaks. Yes, we get those. And I've been speaking about sharp, isolated troughs. Yes, we get some of those. But then we also get sharp, isolated peaks. Here we get a very rounded peak. Here we get what looks like it might be a fairly rounded sort of a trough. The answer is we get a very mixed picture, a very hybrid picture. Now, this topic of research fascinates me, and it's something I'm constantly studying, whether we should synchronize troughs or peaks, or whether we shouldn't all. And I leave that as an open question for you. You can explore that in your own time. But I will tell you that there is very evidence that in stock markets, troughs are synchronized, as we have observed, and in commodity markets generally, peaks are synchronized. And there is an example of combining 11 cycles where there is no clear synchronization of troughs or peaks. And you will see examples of sharp troughs, sharp peaks. You'll see mix of all the possible combinations. I see in the chat window a really interesting conversation about why troughs are synchronized in terms of the reasoning. Okay, what is the reason? Why are troughs synchronized? Why are peaks synchronized? And David has mentioned that it has to do with fear and greed. Now, my friend and colleague Ray Tomes, a cycles researcher, suggested that in some markets, troughs are synchronized because of exactly that, the relationship between hope and fear, or greed and fear. But he describes it as hope and fear. And in stock markets particularly, stock markets tend to rise when people are feeling hopeful. They're feeling really positive about what they're doing, about the economy. They're feeling wonderful. That hope, or perhaps it is greed, causes stock markets to rise. However, when they're feeling fearful, of course, it causes stock markets to drop. And probably those emotions of hope and fear are influenced by the cycles. So we have a 40-day cycle of hope, and then fear. Similarly, we have an 80-day cycle, a 20-day cycle. The constant switching between feeling hopeful and feeling fearful. Okay, and the reason why troughs are synchronized in stock markets is because of the way in which stock prices react to the emotions of hope and fear. When we're feeling hopeful, stock prices rise. When we're feeling fearful, stock prices fall. Ray Tomes suggests that the converse, or the opposite, happens with commodity markets, that when we are feeling hopeful, the prices of commodities actually drop. And when we are feeling fearful, the prices of commodities or precious metals, I believe precious metals follow the same rules, the prices of commodities or precious metals, when we're feeling fearful, rise. And that gives us the principle of synchronicity, which is either synchronized troughs or synchronized peaks. Now, just to wrap up this discussion of the principle of synchronicity, why is it important? Why have I spent the last half an hour speaking about the principle of synchronicity? Why is it an important principle? Well, because it has a big impact on the analysis that we perform and the way in which we perform that analysis. Simply put, when we're performing a standard Hurst cycles analysis, we use troughs instead of peaks to perform that analysis. If I go back to our chart of the S&P 500 or the ES futures, then of course at the foot of this chart I have plotted using the diamonds as trough markers. I've plotted where troughs occur. I haven't worked out where the peaks occur. Well, you might know from last week's webinar that I have actually, but I'm not showing that. And a basic or a standard Hurst cycles analysis performs the analysis on the basis of where the troughs occur. The first thing you're doing when you're performing a Hurst cycles analysis is you're identifying the position of the troughs. So when you perform an analysis, you say to yourself, okay, that's a big trough in price. And this is another big trough in price. And so now let me measure the distance between those two troughs. And so you can measure the distance between those troughs and you can say there were 316 days. Therefore, that is probably a 40-week cycle. Putting it simply. So that is the big difference, is that we use troughs to perform our Hurst cycles analysis, and we do that because of the principle of synchronicity. When performing an analysis on a commodity or a precious metal, I believe you should look more carefully at the position of the peaks as opposed to the position of the troughs. Why else is the principle of synchronicity really important for us? It's really important because of what it means for our trading. And this is a really fundamental, vital, crucial point. I cannot emphasize this enough. It's because when we are approaching a trough in a market that has simultaneous synchronized troughs, that is a very different experience to the experience of approaching a peak. That's an important point. When you're approaching a trough as a Hurst cycles trader, you are probably short, because you're expecting the market drop down into that trough. Price will then bounce out of the trough. So your trading decisions involve, where do I enter into a long position and where do I exit from my short position? So you're thinking about buying. On the other hand, as a Hurst cycles trader, when price is approaching a peak, you are probably in a long position and you're considering, when should I exit from my long position, or when should I enter into a short position? In other words, you're thinking about selling. Now, many traders consider those two activities to be the same basic activity. You're thinking about buying or you're thinking about selling. But for a Hurst cycles trader, those are two very different activities, because when you're approaching a trough in a market that has simultaneous troughs, you're expecting a sharp plunge down into that trough. You're expecting the formation of a sharp isolated trough and then a strong bounce out of the trough. And you're going to trade on the basis of that expectation. When you're approaching a peak, however, in a market that has simultaneous troughs, you are expecting multiple attempts to form that peak. You're expecting the formation of a rounded peak. You're expecting clustered peaks, clustered and rounded peaks. So your decision to enter into a short trade is going to be very different. And for that reason, Hurst's trading methodology takes a very different approach to entering into long trades as it does to entering into short trades. Of course, it depends what trading methodology you use, but if you are using Hurst cycles, you will need to take a different approach in trading when price approaches a trough to when it is approaching a peak. And that really summarizes the importance of the principle of synchronicity. That's why the principle of synchronicity is so important to us. For all those reasons, I hope that you have found that to be an interesting discussion about the principle of synchronicity. Let me take a moment now to answer any questions that might have come up before we take a look at the price of crude oil and an analysis of which I want to speak about today, because crude oil is a fascinating market, particularly to do with this principle of synchronicity. So here we go. Let me see some questions. I spoke to Aaron's question about cycles moving at the same speed. It's again something I would need to answer later, but the simple answer to that, Aaron, is no, cycles move with a particular speed, which is their amplitude. And it is the combination of multiples that causes the sudden acceleration and deceleration of price movement. Cedric says, or market movements driven by deleveraging. Okay, I think I missed the context of that, so I'm not going to be able to speak to that right at the moment. Marcus, my biggest challenge with Hurst has always been that sometimes the cycle pleats early or late, absolutely, relative to when it was expected. So the phasing has to be constantly adjusted, making positions difficult. Are there specific stock that behave presumably, in other words, more consistently? Has any work been done to identify a pattern of when that happens for a specific stock? For example, a rule like Apple cycles always speed up late in the year and slow down early in the year, things like that. Marcus, there has been quite a lot of research done in terms of the way in which cycles move. And there is a trading methodology that takes as its basic principle that that a particular market or a particular stock will move with a particular characteristic. So the simple answer to your question is yes, you can explore that. And in Sentient Trader, it's called the sentient wave shape statistics. So I'm not going to dwell on it in this webinar. It's going to have to be the subject of a completely separate webinar. But if you take a look at the sentient wave shape statistics for any one of your analyses, then what those statistics tell you is they tell you to what extent price tends to bounce out of a trough, to what extent it tends to plunge down into it for each cycle. So it presents a range of statistics. In terms of it being seasonal, such as you mentioned, late in the year, slow down early in the year, to my knowledge, no research has been done with regards to that. It would be a very, very interesting piece of research to do. But no specific research, as far as I'm aware, has been done in terms of the time of year, but it sounds like a very interesting field of research. Lastly, you say, are longer cycles more reliable than shorter ones? Is an 18-month cycle trough more reliable? Does it have a larger or longer bounce outward than a smaller cycle? Yes. Certainly longer cycles tend to be more reliable. They have less variation. But the basic point behind your question is a very important thing, which is that when price is moving down into a trough, you've got to be very careful about getting into a trade too early, jumping conclusion that the trough has formed when it hasn't. And I wish I could give you a very simple black and white answer and say, this is how you do it and this is how you know. That question really is at the core of what makes trading using Hurst cycles such a fascinating process. That is the discretionary process involved in analyzing using Hurst cycles. Hurst himself said that analyzing the markets is as much an art as it is a science. And that is where the art comes in, is you look at those cycles and you look at the analysis and you use your knowledge, your experience to determine whether a particular cycle trough has come in. And that's one of the reasons why I'm so pleased to be doing these webinars, because so much about Hurst cycle analysis is not simply the black and white yes or no answer. It has to do with subtleties. It has to do with experience. It has to do with performing an analysis and doing it again and again over many years. So that's what we're all doing here. I hope that provides somewhat of an answer, but also an encouragement, certainly, that you have identified one of the big issues. So, a question from Alain: if you consider the DAX 30, the CAC 40, and the Dow 30, 70% of the shows made alone March 2003 and 2009. 15% in October 2008. The rest is scattered over time. Okay, so Elaine is speaking about commonality and looking at troughs of different magnitudes potentially happening at different times. It's a great point. It's a very important point. The principle of commonality is another really important principle, and something we'll have to discuss in a future webinar. So I'm not going to be able to speak much more to that, but it is a really important point, and it's a very useful thing to do, just as a matter of interest, is to make sure that you keep an eye on what's happening in diverse markets around the world. I think that's really, really important. I see a question from Piotr. Can triangles, wedges, and diamonds be explained by Hurst cycles? And I think David's providing some answers there, so that's great. Yes, they can, Piotr, and it's very interesting to see how Hurst cycles answer all of those questions. The formation of a triangle, for instance, and a weird thing that very, very often happens around a mid-channel pause. But let's try and keep on topic for today's webinar, and if I have a bit of extra time, perhaps we can explore some of those other ideas. I really want to get to a discussion of crude oil. And the reason I wanted to speak about crude oil today, not only because it was our second most requested instrument in the first survey that we did about topics or instruments to speak about in these webinars. Crude oil was our second most requested instrument, but it's a very, very interesting instrument, in my opinion, and that is because it raises the question of, are the troughs synchronized or are the peaks synchronized? Whenever I analyze an instrument, I question the principle of synchronicity. The principle of synchronicity is alive and well, and it's there, and it works. But the first thing I do when I analyze an instrument is I ask myself, are the peaks synchronized in this instrument, or are the troughs synchronized? So this is crude oil. I'm using the CL futures prices here, and so let me ask you the same question that I've asked previously when we looked at price movements. Do you see sharp isolated troughs or sharp isolated peaks? Here I can see a sharp isolated trough. Here I can see a very sharp isolated trough. But here I can see a sharp isolated peak. Here I can see another sharp isolated, and here possibly as well, although that might be a rounded peak. Here, as a matter of interest, we're seeing a bit of a triangle to get to Piotr's question about triangles in markets. So what are we seeing here? Sharp isolated peaks, sharp isolated troughs. Are the troughs synchronized or are the peaks synchronized? Crude oil is a fascinating instrument because I don't think there is a simple answer. And so let's have a look at the analysis of crude oil. And we're going to start speaking about this using synchronized troughs or simultaneous troughs. In other words, the principle of synchronicity as Hurst originally defined it. And you can see the analysis at the foot of this chart. Here we have the longest cycle that has been found in this analysis is the 9-year cycle. So we had a 9-year trough in 1999, 9-year trough in 2009, and our next 9-year trough is expected, very roughly speaking, in about early 2019, perhaps late 2018. That's the really big picture according to this analysis. So let's zoom in and let's see what's happening to this current cycle. As you can see, price bounced out of the trough there and now down again. We have 3 18-month cycles. The first one formed a trough here in April of 2010. The next one, according to this analysis, in June of 2012. And the third one, which of course must be synchronous with the 54-month cycle, is in early 2014. Here we have an interesting situation where we have the trough of the 54-month cycle right up there. Let's speak about that for a moment. I mentioned in last week's video that one of the really important things you need to bear in mind is that not all the really big troughs or big cycle troughs that you see in the market are going to be that impressive. They're not all going to be balanced. Why is that? Well, it's because of the influence of the longer cycles. So assuming this analysis is correct, the 54-month cycle trough did occur at the beginning of 2014. Uh, why did that trough occur so high? Surely we would have expected it to come all the way down. Surely this is the trough of the 54-month cycle that we're seeing now. Well, it might be, but let's not rush ahead yet. Let's first of all speak about how it is possible that the 54-month cycle might have occurred at the beginning of 2014. The reason is very simple, and you can see it in this chart, that the 9-year cycle was pulling prices upwards. And the 9-year cycle was forming a peak at around about that time, and that is why that 54-month cycle trough doesn't look as dramatic, as impressive, as low as you might think it should. So this is a very valid analysis. There is nothing wrong with it, but of course it does raise a few questions, and one of the really big questions is that if this was the 54-month cycle trough that formed over here, then surely we should sort of a gradual decline down in the next 9-year cycle trough over here in 2019, late 2018. So why has it suddenly accelerated so strongly to the downside? Well, of course, the answer might be is not the 54-month cycle trough over here. The answer might be that the 54-month cycle trough is only really occurring round about now. So in Sentient Trader, we can simply create another chart, and we can get Sentient Trader to form a slightly different analysis answering that question. Before we do that, let's just zoom in and see what this analysis is happening now, because we're hopefully going to be making a trading decision fairly soon, and we need to know what's happening now. So here is the first 18-month cycle that has played out since the 54-month cycle trough at the beginning of December. There it is there, with an 18-month cycle trough over here. You can see I've pinned that, and I can explain that perhaps later. But since then, a 20-week cycle trough form, a cycle play out, with the 20-week cycle trough forming over here, recently August. So what is happening now? Well, prices is bouncing out of a 20-week cycle trough, and it's then going to come down into this 40-week nest of lows. Okay, so that's what's happening now. And we're in our second 18-month cycle in the current 54-month cycle. So this cycle is expected to be less bullish. Let me just zoom out again. This cycle is expected to be less bullish. There we go. Let's just zoom in like that. Than the previous 18-month cycle. How bullish was the previous 18-month cycle? Well, it wasn't. Here is the previous 18-month cycle. It was very bearish. So if we're expecting a less bullish 18-month cycle, that means we're expecting an even further bullish move. So yes, the price is bouncing out of a 20-week cycle trough according to this analysis, and then it's coming down into a 40-week cycle trough. But the longer term picture is infinitely bearish. It's looking very, very very bearish, very depressing for people who like oil or want oil to be bullish. But now what if that 54-month cycle trough isn't correct in early 2014? What if instead that 54-month cycle trough should be occurring now? Well, I'm not going to spend time actually doing that now in front of you, but we simply create a new chart in Sentient Trader, and we fiddle with some of the analysis details, and we can come up with a reasonable analysis that does show the 54-month cycle trough as occurring here. Can you see when the previous 54-month cycle trough was, though, according to this analysis? It was over here. So yet again, there's something that just doesn't really make sense according to this analysis. So both of our analyses are raising questions. There's something that's not quite right. What could that be? Well, in the past 5 years of working with Sentient Trader, the way that I've always looked at the situation is I've questioned the principle of synchronicity, object of today's webinar. I've said to myself, okay, is it possible that in fact the troughs are not synchronized in this market? Maybe those peaks are synchronized. Is that possible? And I start measuring the distance between some peaks and I start asking myself, 33 month distance there. What's that? That's a 27-month distance over there. I start measuring the distance between peaks and asking myself whether it's possible that, in fact, the peaks are synchronized instead of the troughs. So I've done that again in Sentient Trader, and I performed an inverted analysis. Now, this inverted analysis shows some interesting things. It shows us that we had a really strong peak of the 9-year cycle in 1990. The next peak of the 9-year cycle was in, what was that, 2000, I think. The next peak of the 9-year cycle was over here in 2008. I think it was early 2008 that peak formed. And the next peak of the 9-year cycle is probably somewhere over here, which is in the rescue line, looks like late 2017. So that's what I've always done in Sentient Trader up until now, is I've questioned the principle of synchronicity, and I've performed an inverted analysis, and I've kept 2 charts, and I've asked myself what those 2 charts are telling me. As a matter of interest, what is this chart telling us to expect? Well, if it has synchronized peaks, then of course we expect a generally W-shaped price movement. So here, W price movement of the first 18-month cycle. We're in the next 18-month cycle, which should be less bearish because we're speaking about peaks being synchronized. So possibly that's going to be a neutral 18-month cycle. We don't know. And then, of course, we expect a bullish 18-month cycle to complete the complete W shape. So that's what this inverted analysis is. But now, what is actually going on here? As Stuart mentions, he says both troughs and peaks are not exactly synchronized. Yes, indeed, that is a possibility. If you're a Hurst purist, you probably need to block your ears at a point. But yes, it is possible that neither the peaks nor the troughs are perfectly synchronized, but perhaps they go through periods of time when they are, because there is the definite evidence in the market that peaks of the cycles are at times synchronized and troughs are at other times also synchronized. But perhaps they are not perfectly synchronized all the time. So, of course, working with the new version of Sentient Trader that we are starting beta testing later this week, we're able to apply a double analysis, which is exactly what I've done on this chart. And here you can see the results of performing a trough-based analysis and a peak-based analysis on this chart. I'm going to show you now something very interesting that happens as a result of producing a combined analysis. If you draw a line between the troughs of matching cycles from the trough to the peak, you get that line from the 9-year peak. Then from the 9-year peak to the 9-year trough, you get that very, very, very steep line over there. Okay, then price moves up to the 54-month cycle peak, and then down to the 54-month trough, and so on. So it provides us with quite an interesting way of looking at price movement, assuming not simply the price jumps from one trough to the next trough to the next trough, or from one peak to the next peak to the next peak, but we start looking at price movement as occurring from a trough to a peak, and then back to the trough again, and then back to the peak, and so on. So let's take a look at this analysis and ask ourselves, I'm just going to hide the peak analysis there for a moment, and let's ask ourselves what we expect to happen. What is going to happen next in this market? And as you know, we've got a feature in Sentient Trader called the composite model line. So I'm able to, instead of squiggling all over the chart, able to display the results of applying all our knowledge of the cycles that are currently active in the market, and we can see what should have happened, and we can start beginning to make some trading decisions. So there is the composite model line for this analysis, which assumes that the 18-month cycle trough occurred in August. And as you can see, according to this analysis, we are expecting a fairly slow pull up out of that trough, which is then going to accelerate. And then we're going to get another similar slow shape, and then further acceleration to the upside. Now, do you notice something about that? I've been speaking about sharp isolated troughs, sharp isolated peaks, and rounded clustered troughs, and all that kind of thing. Can you see what our composite model line is showing us? It's showing us a not very sharp isolated trough. It's showing us that the bounce out of this trough is likely to be fairly sluggish before it actually picks up speed. That's an interesting possibility. But before we start making any firm decisions, let's take a look at our alternate analysis, which positions the 54-month cycle trough over there. And let's again apply our composite line and see what that composite line tells us. Now, that composite line has dropped right off the bottom of the chart. Can you see that? I've had to sort of drag the chart up to incorporate it. That is because, according to the cycle model that has resulted from this analysis, the software expected price to drop really sharply into this trough. Well, it dropped fairly sharply, but not nearly as sharply as was expected. What's more important, what's going to happen next? Well, the composite model line shows us a bit of a bounce up and then a flat line, and then again a rounded trough. Do you see that? Okay. So even though we have two different analyses here, we have very similar outlooks. Now you must bear in mind that with this composite model line, you don't look at exact price levels. We're not expecting price to drop all the way down to this level. We're looking at the general shape of the price movement. That's quite important. So the general shape of this movement is that it forms a rounded trough before accelerating to the up. Now, there is another analysis that is also very possible and very viable, which considers, I noticed David Furlow mentioned, interestingly, Brent crude oil made us earlier in January of 2015, exactly, and because Brent crude made a low in January of 2015, one of the possible analysis outcomes that we need to consider is this one. And I seem to have a habit of always showing my favorite analysis last. I don't know why I do that. But this is probably my preferred analysis in crude oil at the moment. I do have a double analysis, as you can see. There's the peak analysis. But this is my preferred analysis. And let me just point out it's a really big difference with this analysis. This analysis shows us that the month cycle played out like this, forming a trough either in January or over here. I prefer March in this particular analysis. And then we have since then seen a 20-week cycle trough. Now we're going to see another bounce and then a move down into the 40-week cycle trough near the beginning of 2000. Let's quickly have a look at our nice new composite model line, which I don't know if I've got it. Yes, there it is. Okay, our composite model line for this analysis shows us an interesting and different picture. It shows us that the big trough that, I say big trough, but the trough that formed here in August was not actually that important a trough because it was only a 20-week cycle. And what's going to happen next? Price is going to slide downwards into this 40 cycle nest of lows here in early 2016. So there we have three different analyses and three different outlooks. How do we make a trading decision? My trading decisions are simple. I take a look at all the different analysis outcomes and I ask myself, what do I really from this market? My preferred analysis is this one that we're looking at now, which shows that we're enjoying a little bit of a bounce here, but I'm actually expecting price to move down. Possibly not down very strongly. It might sort of dribble downwards according to the composite model line, but we mustn't rely entirely on that line, which is still in its experimental phase at the moment. But that's certainly what I would expect. I would expect crude oil to drop down into a trough in about 2006. In the other analyses that we saw, they painted a slightly different picture, indicating that this trough was more important, but the price is likely to take a little bit of time before it actually kicks up and really moves forward. Let me just end the discussion and speak very quickly about how I would make a trading decision right now on crude oil. Let's hide that composite bottom line before it distracts us. I would simply show the FLD. I love trading on the basis of the FLD. And you can see here, according to this FLD, price crossed above the FLD here, giving us a very nice projection up to this level here. That's the A category. Then we had the B category where price tracked along the FLD. It jumped up again. What's happening next? A short trade. Okay, so I would enter into a short trade at the level of that 20-day FLD, which occurred, I believe it was yesterday, triggered yesterday. And in fact, we can have a look at the Hurst cycles, the Hurst signals, I beg your pardon, the Hurst signals signal, which indicates the same thing, trading on the basis of the 20-day FLD. Here you can see the current interaction between price and the FLD is a category action, which is a short trade. So in the short term, in terms of a trading decision right now, we're looking at a short-term trade. Interesting, because last week we were looking at a short-term long trade in the stock markets, and I indicated that I expected price to turn down pretty much over the weekend. Price did turn down, of course, on Thursday. Whether that is the turn that we've been expecting, we don't know. We can't really tell yet. But that would be my approach to trading crude oil. Let me quickly take a look at some of the comments there. Silent one, I think the January low with Brent was the 10-month cycle low, but it expanded bearish. Next low will be the 20-month due by late 2015, early 16. So Silent one is saying effectively looking bearish as I understand that into the end of 2015, early 2016. And let me see if there are any other questions. Let me just switch windows here. Aaron says, looks like the smaller cycles on the bottom lined up, the big ones on the top. Okay, so yes, okay, so we're speaking about the principle of synchronicity, and that speaks directly to it. A very interesting thing starts happening, and I don't want to start getting everybody horribly confused, but a very interesting starts happening when you consider simultaneous peak and trophies. I've been playing with this for some time, and I find it fascinating. As you say, some of the shorter cycles sometimes almost seem to line up with the peak markers. So here, for instance, you can see a 20-week cycle, and here is a 20-week cycle peak. And look at the strength of that move from the trough to the peak. That's because the cycles that are potentially driving that move are a bounce out of the 20-week cycle trough and a rise up into a 20-week cycle peak. Okay, that's what gives us such a strong move. And on the other hand, you'll sometimes find examples of cycles where you don't get such a close match between the cycles, and therefore you get a slower speed, if you like, to the cycle move. But that is clearly going to have to be the subject of a separate webinar, is the calculation of the cycles, because here the calculation of the cycle speed is a fascinating subject, and I believe it does have a bearing on performing a simultaneous trough and peak analysis. I see Silent One saying the peak and trough analysis is very useful in the same chart. I think it's very useful. As you know, in fact, I spoke to you about it over a year ago. I'm working with this, and so it is it is certainly a very, very useful approach. Are there any other questions? It's time for us to wrap up. We've been running over an hour, and so if you have any specific questions, I'd be happy to try and answer them. If not, please take a look at our other resources, how to learn about Hurst cycles. Go and check out our podcasts. We're going to be putting together cut downs of these webinars into the podcasts, so just the content, which I hope you will find useful, and of course various other videos and documents that you can take a look at. Thank you very much for joining, everybody. I see everybody signing off to go trading. Thank you very much for joining me on today's webinar, and thank you for your interest in Hurst cycles and Sentient Trader. And I look forward to seeing you next week. We are at the moment going to be doing these webinars every week. I am going to be I'm not going to be doing weekly webs forever. I'm going to be running weekly for a while, and then we'll take a few weeks off and so on. But thank you so much for joining me, and I look forward to seeing you next week. And for all of those of you who have asked about the beta testing, I know many of you have been emailing saying beta testing the new version. It is coming very soon. We're sorting out a few final details, but that will be coming very soon to Sentient Trader users. So that's something to look forward to. Thank you very much for joining me. I look forward to seeing you next week. And in the meantime, I wish you profitable and have a good week.